Investing in stocks means buying shares of ownership in a public company. Those small shares are known as the company's stock, and by investing in that stock, you're hoping the company grows and performs well over time. When that happens, your shares may become more valuable, and other investors may be willing to buy them from you for more than you paid for them. That means you could earn a profit if you decide to sell them. A good rule of thumb is to have a diversified investment portfolio, and to stay invested, even when the market has ups and downs. Welcome to this investment channel. Watch the full video to know more about stock market. What is the stock market? Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own all the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stock so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual. So it's a very difficult game for the individual to win over time, says Dan Keaty, CFP, Chief Financial Planning Strategist at TIAA. If you're analyzing a company, you'll want to look at a company's fundamentals, earnings per share or a price-earnings ratio, for example. But you'll have to do so much more: analyze the company's management team, evaluate its competitive advantages, and study its financials, including its balance sheet and income statement. Even these items are just the start. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. What they forget about is that often they're not talking about those particular investments that they also own that did very, very poorly over time, Keaty says. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market, and sometimes they confuse luck with skill. You can get lucky sometimes by picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. There are tons of smart people doing this for a living, and if you're a novice, the likelihood of you outperforming that is not very good, says Tony Madsen, CFP, founder of New Leaf Financial Guidance in Redwood Falls, Minnesota. An alternative to individual stocks is an index fund, which can be either a mutual fund or an exchange-traded fund. These funds hold dozens or even hundreds of stocks, and each share you purchase of a fund owns all the companies included in the index. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk. Try how you might. Anytime the market changes, we have this propensity to try to pull back or to second-guess our willingness to be in, says New Leaf's Madsen. That's why it's important to prepare yourself for downturns that could come out of nowhere, as one did in 2020. You need to ride out short-term volatility to get attractive long-term returns. Amazon. The good news is that a challenging 2022 positions Amazon for a better 2023. The profit comparisons will be easier, for one. More importantly, CEO Andy Jassy is focused on streamlining the company's cost structure. Amazon spends a lot of money in areas that aren't profitable, including its international and device segments. The efficiency focus should usher in strategic changes in those areas, plus cost-cutting and ongoing activities like package delivery. Amazon also repurchased billions in common stock in 2022, for the first time since 2012. The company has $6 billion remaining on its share repurchase authorization. Continued share buybacks would support higher earnings per share later. On top of those factors, Amazon's stock price looks cheap right now relative to its history. The consensus price target for Amazon is about $140, while the stock currently trades below $90. Chipotle Mexican Grill. Chipotle stock is down about 20% since the start of 2022. The restaurant chain has been managing the same headwinds that are putting pressure on your household grocery budget: higher prices on dairy, avocados, and tortillas, Packing costs have been on the rise, too. Still, Chipotle's food, beverage, and packaging costs, as a percentage of total revenue, declined by 50 basis points in the third quarter versus the prior year. That's possible because the chain has pricing power, meaning it can increase menu prices to offset rising costs. How far Chipotle can push its menu prices remains to be seen. CEO Brian Niccol has said they may be losing some lower-income customers, but they're gaining higher-income households at the same time. Dollar General stock is up 3% in 2022, even as the S&P 500 has fallen nearly 20%. Throughout this year, the chain has reported increases in foot traffic and in how much customers spend at each transaction. Dollar General is feeling the pressures of higher costs, though. In response, company leaders are focused on streamlining their supply chain. Those efficiency efforts can help with the current inflation trend, but will also create long-term advantages. Meanwhile, Dollar General is supporting revenue growth through expansion. The third quarter 2022 revenue increase of 11.1% came from new store openings plus a 6.8% increase in same-store stores, partially offset by store closures. Third quarter net income grew 8% despite some gross margin pressures related to higher product costs. Eli Lilly's stock is up 31% in 2022, an uncommon bright spot in a down market. The company benefited from a third quarter launch of its type 2 diabetes drug, Mounjaro, plus growth from breast cancer drug Verzenio, diabetes drug Trulicity, migraine drug Emgality, and others. The pharma company's revenue grew 7% on a constant currency basis in the third quarter. Earnings per share in the same quarter increased 12% on a non-GAAP basis. Subscribe to our channel to keep up with new content. Your subscription, support, and feedback are much appreciated.